please make sure to subscribe. What is intrinsic value? Intrinsic value is the measure of what an asset is worth. This measure can be quite difficult to arrive to, but it is essentially what you are willing to pay for an asset. The methodology behind determining the intrinsic value of an asset will be different depending on the asset class. Valuing assets is a complex process because of their infinite life and the difficulty of estimating future cash flows. There are three basic approaches to valuing assets: discounted cash flow valuation, relative valuation, asset-based valuation. Investors frequently use more than one approach to estimate the value of an asset. Once an estimate of value has been determined, it can be compared with the current price of the asset to determine whether it is overvalued, undervalued, or fairly valued. Let us begin with the discounted cash flow valuation. The discounted cash flow, or the DCF valuation approach, considers the time value of money. This approach estimates the value of an asset as the present value of all future cash flows that the investor expects to receive from the asset. In order to conduct a DCF analysis, an investor must make estimates about future cash flows and the ending value of the asset. The investor must also determine an appropriate discount rate for the DCF model. Understanding that the discount rate is an educated guess and not a scientific certainty. The higher the discount rate, the lower the present value of the future cash flows. Investors can use the concept of the present value of money to determine whether future cash flows of an investment are equal to or greater than the value of the initial investment. If the value calculated through DCF is higher than the current cost of the investment, the opportunity should be considered. If the investor cannot access the future cash flows, the DCF will not have much value and alternative models should be employed. Let us proceed with the relative valuation. Relative valuation relies on the use of ratios in comparable industries and asset classes. The relative valuation approach estimates the value of an asset using a ratio. The ratio is determined based on price and the specified relevant measure. The key assumption of the relative valuation approach is that assets in the same industry with similar risk and return characteristics should have similar values. One ratio commonly used in relative valuation for stocks is the price-to-earnings ratio, which is the ratio of a company's stock price divided by earnings per share. For instance, a publicly traded company that generates annual earnings per share (EPS) of $1 and is trading at $12 per share has a P/E ratio of 12. In other words, a P/E ratio of 12 suggests that investors are willing to pay $12 for every $1 of earnings that the company generates. A common ratio in the real estate industry is the cap rate ratio. It is the ratio of a rental property's net operating income to its purchase price, including any upfront repairs. Cap rate equals net operating income, NOI, divided by purchase price. For example, if an investment property costs $1 million and it generates $75,000 of NOI, net operating income, a year, then it is a 7.5% cap rate. Usually, different cap rates represent different levels of risk. Low cap rates imply lower risk, higher cap rates imply higher risk. The third and final type of valuation is the asset-based valuation. The asset-based valuation approach estimates the value of an asset by calculating the difference between the value of total assets and its outstanding liabilities. In other words, the asset-based valuation implicitly assumes that the company is liquidated, sells all its assets, and then pays off all its liabilities. The residual value after paying off all liabilities is the value to the investor. Please keep in mind the values of some assets on the balance sheet are based on historical cost, the cost when they were purchased, and the actual market value of these assets may be quite different. Estimating the value of the equity of a company using asset values taken directly from the balance sheet may provide a misleading estimate. To improve the accuracy of the value estimate, current market values can be estimated instead. Also, some assets may not be included on the balance sheet because of financial reporting rules. It is important that investors using asset-based valuation estimate reasonable values for all of a company's assets, which can be challenging to do. Let us recap. The discounted cash valuation approach relies solely on estimates of a company's future cash flows and implicitly assumes that the asset will continue to operate forever. In contrast, the asset-based valuation approach implicitly assumes that the asset will stop operating and essentially provide a liquidation value. The relative valuation approach does not estimate future cash flows, but instead assumes that assets in the same industries that have similar risk and return characteristics should have similar price ratios. Please make sure to subscribe, like, and comment. We will see you soon in our next video.